Chinese stocks were weaker, with small cap companies leading the decline despite stronger than expected GDP data. China's GDP grew 5.3% in the first quarter from the year earlier, comfortably above analyst expectations. However, a raft of March indicators released alongside the GDP data showed that demand at home remains weak. Meanwhile, the market is also tracking broad Asian stocks lower. Hong Kong's Hang Seng Index down 2.1%. Mainland China's Shanghai Index lost 1.6%, and Japan's Nikkei declined 1.9%. Over in the United States, stocks closed sharply lower as an early lift from a strong retail sales report succumbed to a jump in Treasury yields. Concerns about rising geopolitical tensions between Iran and Israel has also weighed heavily on markets. The Dow Jones fell 0.6%. The S&P 500 losing 1.2%, and the Nasdaq down 1.7%. To give us more perspective on the markets, we are joined by Martin Smith from Anchor Capital. Martin, thank you so much for your time. I mean, we got this GDP report coming out of China, but at the same time, in the background, we've got these Middle East tensions. We're still dealing with the idea that perhaps these interest rate cuts might be delayed. Given that overall picture, what's your sense of market performance right now?
I think you put it in a nutshell. You've got a lot of overhangs at the moment. Interest rates maybe not as favorable as people would have liked kind of towards the end of the year, worry about what's happening in the Middle East. And then again, those retail numbers, which essentially basically say that the US consumer, which is about 60% of the US economy, is very, very strong and can withstand the higher for longer interest rate environment. So not particularly good for equities, that environment with higher interest rates and also the kind of uncertainty we've seen. So a bit of volatility as we can expect, but again, as we've seen in the last 6 months, specifically around interest rates, the target's always moving, and let's see if that continues.
Let's talk about this China GDP numbers for the first quarter. I mean, is this what we're looking for when it comes to that recovery regarding China, or is it too early to tell?
I think it's too early to tell. We also had industrial production numbers and retail sales missing for March. So a little bit of a contrast to these GDP numbers, which were better than expected. Hopefully, we're starting to see some green shoots and things starting to turn around in China, which I think the market's been hoping for the better part of 18 months. But for now, it's just a number. Whether they can sustain it, I think, is the big thing that the market's going to look out for. Because again, we're waiting for a turnaround, and the valuations of Chinese stocks are very, very attractive. So if we see a bit of a momentum shift from a growth perspective, I think we could see quite a nice bit of performance from the Chinese market.
When it comes to US yields and the way they're moving so far, I mean, what kind of cues and signals are you taking from that? Is it a harbinger of things to come? How are you looking at it?
I think the best way to look at it is, I think it's a function of just how strong the US economy is. We talk back again about those retail numbers that came out and how strong they were. And I think it kind of talks to the fact that maybe the rate cutting cycle will be a little bit more shallow than previously anticipated. So maybe the market was looking for 6 to 7 cuts over the next kind of year or two. It's probably now 4 or 5, given, again, how strong that US economy is and how much of a high interest rate environment it can kind of sustain. So I think it speaks more to that than anything else. But yeah, again, this has just been a moving target for the last 18 months.
Speaking of this moving target, how many rate cuts are you looking for specifically, given the fact that we've repriced rate cuts so much this past few months? I'm wondering whether you've lowered it down to a particular single digit or even no rate cuts at all.
No rate cuts, that's a little bit scary. No, but you're so right. I mean, at the beginning of the year, the market was pricing in 1.5% worth of rate cuts starting in March. That's now been pushed out to 50 to 75 basis points, what the market's looking for. We are on the side of 50 basis points cut over 2 kind of meetings, and the first of which starting in September. So it's amazing how much the market can shift in just a few months with the data that's kind of been presented. So that's what I'm saying. Let's keep an eye out. Let's watch the markets and watch the data that comes through, because these targets are always moving. But for now, 2 rate cuts of 0.5% by the end of the year is what we're saying.
When it comes to expectations for U.S. earnings season, I mean, we had the banks kick us off on Friday. We had Goldman Sachs yesterday. What are you looking for in terms of themes or expectations, or even just particular earnings per share figures?
So I think the kind of overall growth that we're looking for from the S&P 500 is about 6% growth. And that ties into the expectation of about 10% growth on aggregate for the year. So I think the thing that needs to play through is that we need growth to really kind of catch up to the prices that these shares have been kind of trading on, because the valuations across the kind of S&P, or even on average, is a lot higher than it has been over time. So you need earnings to kind of play catch up to share price movement. So I think the biggest thing to look out for is, do earnings follow share prices? And also just, I think, the ability for companies to pass on the higher inflationary environment to the consumers. I think that's one thing to keep an eye for as well.
With just a minute left, 1 or 2 particular companies you're going to be paying attention to during this earnings season?
I think the biggest are, I mean, obviously we've had the banks, and it's been a bit of a mixed bag there. Like you mentioned, you had Goldman Sachs doing very well on the back of 28% profit increase, and a little bit less of an interesting move downwards from JP Morgan. But I think the big thing to keep an eye out for me is these tech stocks, specifically the Magnificent Seven, because you've left yourself not a lot of margin for error in terms of what the prices have done in those shares. So I think those are going to be the big ones to keep an eye out for, because I think where they go, the market goes.
All right, Martin, let's leave it there. Thank you so much for your time. That is Martin Smith, who's a portfolio manager at Anchor Capital, giving us his perspective on the markets and also telling us that we got to look out for the Magnificent Seven. They did particularly very well. So again, it's a question whether these company valuations can actually keep up with what we're seeing from a numbers perspective, but also the outlook going forward coming from a lot of these CEOs.